Hey, what's up, stock compounders? Brad here. So today I want to talk about Kodak one more time. What are the lessons to learn from what's happened with Kodak in the last couple of days? Now, just to give you some framework here, at the end of the day on Monday, Kodak stock was sitting at $2.62 a share. Okay. Today it got up to $59. All right. Right now it's at $33 per share after hours on Wednesday. So if you had bought at the end of the day Monday and gotten out at the high today, that's a 22x in like a day and a half. And even now at 33, it's a 12x. So, at first blush, you might look at my video yesterday and think, wow, this guy really screwed up. He's saying, the stock is overpriced. It's just not going to be a good investment. And look at it now. It's up 12 times from where it was on Monday. Video I made yesterday, I was talking about how it was up 4 times, right? So it's up significantly more than that. So what's the lesson here? Well, I saw something that I really resonated with in a video from Investing with Tom, okay? A good buddy of mine, also a YouTuber. And he made a video called 5 Traits of Successful Investors. And one of them I really want to get into, and that is have an investment process and stick with it. Great investors, they know, they kind of have a systematic approach to what they're looking for in an investment. Monish Pabrai, for example, one of the great investors that I follow, his goal, well, this was his goal up until recently. Maybe it's changed a little bit, but it's generally the same. His goal is to double his money every 3 years, okay? So it's finding opportunities in the stock market where he can pay 50 cents today and that stock will be worth $1 3 years from now. That's all he's trying to do. He's trying to buy 50-cent dollars over a 2 to 3 year time frame. Now, because he has that kind of focus, he knows, okay, this is what I'm trying to do. I'm trying to turn 50 cents into $1 in 3 years. So anything that doesn't fit that framework is gone. He doesn't waste any more time on it. Now, if you're just getting into investing and you don't really have a framework, it's really easy to get pulled in all different kinds of directions, okay? It's something we like to call the shiny object syndrome, okay? So if you see something that seems like it's working, you're like, oh, well, let's try that, right? Here's the issue with that in terms of, Kodak is a great example. So we're looking at Kodak. We notice, wow, there's a lot of activity happening with Kodak. It's up 4 times. Maybe I'll buy some. All right, so you buy some Kodak. Now it's up another 3 times from there, right? Well, what do you do with that? What's your plan? Are you just letting the pricing of Kodak? Are you riding that wave? So the issue is what happens with that. If you do end up selling high, right? You make a profit. Let's say you get in at $12 a share and you sell at 33. So you have a nice little profit there. There's a big problem with that from my perspective. And the problem is what that tells your subconscious, okay? That you made a quick gain on this stock, this Kodak stock. You made a quick 3 times your money in like a day, all right? What that tells you subconsciously is that, oh wow, like this is an easy game. It's a fast game. I can make money very quickly and it's not that hard, okay? And so, great, you look for the next stock that you can make a 3x, 5x, 10x on in less than a week. Um, and you're not just going to put 10% of what you made on Kodak into that bet. You're probably going to put it all in because you think to yourself, this is an easy game. I want to make a lot of money. That's why I'm doing this. So I need to be putting large bets in, right? So that I can get to the promised land faster. Okay, so you take your entire gain out of your Kodak winnings and you put it in this next bet. And say that pays off as well, all right? Now you think, wow, this is easy. If only I had more money. It's obviously this is working, but I have limited capital. Maybe I have a couple $1,000s that I'm working with. Well, why don't I open a margin account and use the bank's money, use my broker's money. That way, I can grow it much faster. I'm leveraged. Now, inevitably what happens as you go down this path is you make a bet that doesn't work out and you lose all your money, okay? And if you're leveraged, you're going to lose more than your money. There was a story of a Robinhood trader who, had a couple thousand in, I think, and, his Robinhood account one day showed that he was in the hole, like $750,000, because he was highly leveraged and, whatever trade worked against him. So the problem, as I see it, is that this gambling mentality, this, I can make a quick buck mentality, or I should leverage so I can make money faster, it really programs your mind to think like a gambler when it comes to the stock market. The thing I love about Mohnish Pabrai's approach is that, it seems like a lot to turn 50 cents into $1 in 3 years. I mean, if you look at the return on investment for that, it's an annual return of 26%. You look at the averages of the stock market, 9 or 10%. And by comparison, 26% seems really high, right? But if you're just looking at it in terms of, okay, the stock market is an auction-driven market. Once in a while, I should be able to find opportunities that are 50% off. That's kind of the mindset that Pabrai had, creating this investment framework. I should be able to find opportunities that are 50% off in an auction-driven market like the stock market. And he has been able to do that. He's been doing this for 25 years. He's been investing in stocks for 25 years. And, he's pretty darn near that doubling every 3 years number that he set out to achieve. So, clearly that's a framework that can work. It's a framework that's possible. And we have the added advantage of being able to see what Pabrai is buying, right, through 13F filings. So, and you look at Buffett, there's Bill Ackman, there's all these value investors who, have taken this kind of value investing framework and used it for decades, through multiple recessions. And they've been able to generate, upper teens, even 20% annual returns. So the key is to find a framework for yourself, an investment framework that has a proven kind of history, has a proven track record. I don't know any traders who have gotten rich by trading. You don't see them in the Forbes, in the Forbes lists. Those tend to be long-term oriented value investors. Okay, people who have bought great businesses and had the patience to let those great businesses make them wealthy. That's my understanding anyway. So, when I see all of the activity happening with these businesses like Kodak that just don't have the fundamentals, it makes me nervous for those of you out there who think that this is the path to wealth, to buy a company that's going up in price essentially, and just hope it keeps going up and hope you can get out before it crashes back down. And on top of that, there's a lifestyle associated with that where I imagine it's hard to sleep at night. When your portfolio, jumps 10x one day and you're worried, you're going to lose it all the next day or even more if you're leveraged. So, it's really not just about making money. And I know it's kind of weird to hear me say that on an investing channel, but it's being able to sleep well at night. It's being able to trust your process because you've borrowed key elements of that investing process from investors who have had success with it over the long term. I mean, this is really a long-term game. We're trying to build, long-term wealth, build our way to financial freedom where, we have that choice about what we want to do each day. And, it's really not going to happen overnight. And, investing, I mean, it's really a game. Yeah, I wanted to mention this. It's a game of probabilities. Okay, so going back to Kodak, was I wrong to not buy Kodak at $262 or at $13 a share? Investing is really a game of probabilities. And the challenge is we don't know what the probabilities are. The probabilities aren't written anywhere about, okay, this stock has a 60% chance of, doing this and a 20% chance of staying flat, a 20% chance of taking a dive. Nobody really knows the probabilities, but, investors who have a lot of experience are able to start to see patterns in stocks, okay? And it's really patterns around quality of management, patterns around, okay, does this company have a long-term competitive advantage? Patterns that are linked with the fundamentals of businesses, right? Because when you own a stock, you really own, it's a partial ownership stake in a business. That's really how I approach investing. Traders, look at price. They look at price movements, price action. And, I'm not saying it's impossible to do well with a trading approach. It's not my approach. And a big part of that is I don't know many successful traders. It's hard. It's been hard for me to identify, who are these successful traders over the long term and what can I pull from them to include in my investment process. I just don't have that material to work with. So, my approach is value investing. It's a game of probabilities, and, it's really about understanding the probabilities of upside to the probabilities of downside and only swinging at the pitch when, the upside to downside is heavily skewed towards the upside. Let's say, you have your probability of gain is 80% and your probability of loss is 20%, something like that. So that's kind of how I approach investing. So I do not regret buying Kodak because Kodak, I don't see any long-term kind of sustainable business growth for Kodak. And that's really my game. I'm trying to turn 50 cents into $1 over 2 or 3 years. I'm not trying to do it overnight. Just because I don't think it's very feasible to try to do it overnight. Even if you win once or twice or 3 times, I think it's a very slippery slope into really acting like a gambler, getting that rush, getting that hit of adrenaline when it's really getting your emotions entrenched in your process is my take of it when you have that kind of short-term approach. So I don't regret not buying Kodak. I'm curious to see what happens with Kodak. I'm not necessarily rooting against Kodak. And part of why I'm doing this video is because, I mean, it does happen, guys. When I look at a stock and I think, oh, this is a terrible, long-term investment, and then it goes up 10x or 20x, there is a piece of me that's like, oh man, I could have been in that. I was looking at it, I could have pulled the trigger, and I didn't. And part of why I make this videos like this, is to remind myself that that's not my game, okay? And it's fine that I missed this one, because it just really doesn't suit my temperament. It doesn't suit my style of investing to be trying to get in and out of short-term plays like this. So I just wanted to share that, guys. Yeah, let me know. Let me know what you think of this whole kind of turning 50 cents into $1 in 3 years as the foundation of kind of an investment approach. And, maybe you do think I'm wrong about Kodak, that I was wrong to pass on it because of what the price has done recently. If you do think that, I'm curious to hear your perspective in the comments. I'm not closed to any perspectives here. I'm really here to learn, okay? And to be humble and learn with you guys. So totally open for feedback on this one. Anyway, I will leave it at that. I will see you guys tomorrow. Take care.